All right, Daniel Dario here. I'm going to dive into a fun presentation that I have. So this is a presentation we give to some of our buyers. I actually really put this together to show this to my sales team. And it was based on an interview that I had on the Real Estate Rockstars podcast, where we were talking about the current state of the market. We all know that there's a complete housing supply shortage, but yet we're seeing prices come down a little bit. And you think, okay, well, why is that? Supply usually would have to double, demand goes down, which creates downward pressure on pricing. What we're seeing today is a record low supply, a record high demand, but a demand destruction due to the term, the rate, is making properties unaffordable, causing and pressuring renters to continue to rent and stay into that rental market where rents are going up every year. The average home buyer is 33 years old. They've been probably renting for the last 10 years and have seen yearly rent growths, rents being potentially, 1,200, 1,300 10 years ago compared to now, that's $2,300 a month. So demand being high, supply being low, demand destruction. So what we want to look at is saying, well, if this continues, what is a potential outcome for the future? Now, we can't predict the future, but we can look in the past, and the past will tell us some stories. It's easier for us to go back in time and say, I should have, would have, could have. So this was based on going back in time and giving ourselves advice. If we were in 2052, 30 years from today, and we went back in time, what kind of advice would we give ourselves today? And I figured, well, why don't we have fun with it? My dad bought a home in 1990 and see, okay, let's go back in time to see what it would look like 30 years ago. And I came up with this presentation of the DeLorean. So I'm going to dive into that. First, I'm going to start with just inventory graphs so you can kind of see the current state of the market. I'll flick through them rather quickly. So here is, let me go back to actual beginning part of this presentation, which is the inventory here. So one of the things that we see, the difference between 2007 and 8 crash compared to now is, even though it feels the same, it's fundamentally much different. You had an increase amount of a record amount of supply, 3.7 million properties for sale. Right now, we have less than 1 million homes for sale. Again, record low supply, record high demand. Why is the demand so high? We have a lot more housing formations. We saw a lot more buyers forming new households aging into 33, which is our average home buyer. What did it look like in our county? I think these charts are really cool to see. You could see how many months of inventory we had in our counties as Stanislaus and San Joaquin County compared to where we're at now. We had almost 20 months of inventory compared to a month worth of inventory. Now, you tell me if fundamentally that's the same market. It's not. You could see another chart here, the amount of sales and the amount of homes on the market. We had over 10,000 houses for sale compared to now where we have less than 1,000 properties for sale. Fundamentally a different market. Now, what does that look like? And why is that? Well, home builders were busy. They were building about 20 to 25 million houses every decade. And in the last 10 years, only 5.8 were built. So 20 million less houses were built because of that recession. Prices came down and builders just couldn't build. The economy just stopped, and it took a long time to get out of it. But yet we still have people aging into home ownership. The average home buyer is 33 years old. So if you look at the last crash where you had oversupply and you saw this birth rate drop down, people that were born in the 70s were like abortion came into effect. The birth rate went down, so people weren't aging into 33 to buy property. Now today, the average home buyer that's 33 years old was born in the mid 80s. So what that looks like is people that birth rates past this year continue to go up. So every year, next year, you're going to have more people that are 33 that are looking for a property, more people that are frustrated with the housing market, frustrating with the rental market, and rents going up that are going to be jumping or trying to jump into the housing market. So again, supply, demand. So let's keep going here. And then we're looking at housing formations. We have 14 million new household formations from 2007 to 2021. But yeah, we have 3 million fewer homes for sale. So supply and demand. So let's look at, I'm going to skip all this. Let's go into the DeLorean because this is the fun slide. If we were to go back in the past, what kind of advice would we tell ourselves in 1993? Home prices, rents. Would you tell yourself to buy or not buy? That's the premise of our conversation in the presentation. And then we wanted to go from 1960 to 1990 to 1960 to say, okay, what kind of advice would you give yourself in 1960? Because I know that right now some buyers are hesitant to buy a property, and I get it, right? But if we were to give ourselves advice and come back from 1952 to today, would we be happy or not happy that we bought or sold the property, that we actually purchased and locked in our lifestyle? So that's the question that we want to answer. So let's start with the cost of actual renting. Right now, rent for a 3-bedroom, 2-bathroom house is about $2,100. Now, the average rent increases, about 3% rent growth is what we're seeing. Of course, the last couple of years have been record high, 8, 9, 10%, 12% increases. But on average, you're going to see about 3%. So what does that look like today? That $2,100 rent payment, you're paying about $25,000 a year of your income to rent. No tax deduction, none of that stuff. It's just rent. In 10 years, that rent would be $2,800. In 20 years, that rent would be $3,900. And then in 30 years, that rent will be $5,200. Now, in 30 years, you'll be paying $63,000 of your yearly income to rent. And combined, you would have paid $1.323 million in rent. So I'm in the real estate business, been in the real estate business for a long time. I own rental properties. I own my property. And me thinking that in 30 years, rent will be $5,200 is crazy to think. 150% increase in rents. And I'm sure you probably think the same way. But I wanted to dive deeper into that. So the cost of owning a property over that 30 years, the cost of renting a property will be about $1.3 million. That you never see back, no tax benefit, nothing. That's just the cost of living and having shelter. If you were to purchase a property at $471, which is the median price right now is about $450, and you saw you got a 5% interest rate, 20% down payment, your payment would be about $2,600 a month, which if you look at the amount that you would pay owning a property, you would roughly pay about $31,000 a year. Now that's locked in. You're locked in. You'll see some variance with insurance and all that going up slightly a bit, but you got 30-year fixed mortgage. So in 2052 in 30 years, you'll still be paying $2,600 a month compared to $5,200 a month. And combined with taxes and insurance, you pay about $1 million to house yourself, for shelter. The cool thing is the property would be paid off. So you ask yourself, well, if appreciation in our area is about 3%, what can that property be worth? Can it be worth $1 million? Now it's paid off. Now you have $1 million, a property that's paid off. Now you pay just taxes and insurance, and your cost of living actually goes down. Or you're a renter paying $5,200. You don't own anything. That's a big pill to swallow. Now, if you look at prices, do you think it'll be higher or lower? Think, okay, well, let's take a look at prices and rents. So this is us in 2052. If we come back and give ourselves advice, it's hard for us to think that, but let's go back to 1990. Right now, rent's being $2,100 a month. If we go back to 1990 and say, hey, rents are going to go up 150%, they're going to be $5,200. We probably think you're crazy, just like I think right now. But if we were to tell ourselves that in 1990, we'd probably be thinking about the same thought. But the rents actually went up 160% nationally, 238 here. So think about that. Hard for me to imagine rent being $5,200 at 120%, 150% increase. But the rent actually went up 150% over 30 years. It was hard for us to imagine that in 1990. Now let's go back to 1960. The rent there was $79 a month. If I told somebody in 1960, hey, rent's going to go up 150%, what do you think? What do you think they would say? Probably the same thing we're saying. You're crazy. The rent actually went up almost 700%. So do we think that the rents will maybe go up 150%? Looking at the past, it looks like it's probable, right? Look at what's happened in the last 10 years with rent. So let's look at what that would look like for property values. If I were to say the property value would go up 120%, 150%, what would that look like? The price of that house at to, say it's 471, it would probably be worth almost $1 million. Hard to imagine us paying $1 million for a home in Modesto or in the Valley. But again, you go to 1993 and the price was 125. The price didn't go up 120%. It went up 602% or 242%, because the prices went from 125 to 428. Now, if I look back another 30 years from 1963, they probably thought it would be crazy for the prices to go up 120% as well, but they actually went up 600%. So it's easy for us to give ourselves advice looking back in time, harder for us to take that advice looking into the future. But if we were in 2052, 30 years older, and we came back and gave ourselves advice, same way as we went back to our parents went back to 1990, or our grandparents went back to 1960, do you think they would have said bye? I know it doesn't make sense to you right now. Maybe it's it's a stretch. There's a lot of chatter in the media. You should be afraid. But if you really think of what's happened and what can happen, it's never going to be the same, but it rhymes. And the big difference that we're seeing right now is that the Fed has printed the most money it's ever printed before. So I just want you to look at this graph. And this is Fed reports here. This is a money supply. And you see from 1960 to 1990 how the money supply went up. And in 1990 to 2000 and 2020, money supply went up. The quantitative easing that they did, all the money printing that they did during the last recession was right here. Look at the amount of money they've printed recently. And this is why you've seen soaring inflation. So if it's hard for us to imagine rents going up 150%, prices going up 120% in the next 30 years, but we saw in the past that the rents went up and the housing went up in 200 to 300%. And over 600% over this period. You're telling me that our money isn't going to see some form of inflation, and you're going to see values and rents go up more aggressively than we've seen over the last two tranches of 30 years. So anyways, that is the premise of my presentation. Again, initially I'm like, there's no way, rents can't be 5,000. And I'm like, you know what, let's just look at the numbers. Let's really see what is possible in our area that we can't imagine in the next 30 years happening. And what better way is to look in the past to see what was the state of mind in 1990 and 60, and would they have thought we were as crazy as us today thinking that the rents would go up that much? And the answer is yes. There's a lot of people that weren't advocates also for real estate and locking in their lifestyles in the 90s, and you could see that that was a losing part of the equation. So again, this is why we're so passionately helping our clients, informing our clients to make the best decisions for themselves, really lock in that lifestyle. On one side, your rents continue to go up. Your landlord could tell you, well, I'm selling the property. On the other side, you get tax deductions, you pay off your property, you got pride of ownership. And you don't have to worry about the cost of living going up like crazy. And once the property's paid off, and if values continue to appreciate like they have over the last 100 years, you're going to have a piece of your wealth formed on your investment and decisions you're making today. This is why wealth is either made, it starts or ends in real estate. This is why when you look at people that are the higher 1% of the wealth population, real estate is a big part of their real estate or just the portfolio in general. So anyways, if you have any questions, feel free to reach out to somebody on the team. But just wanted to put this in video form in hopes to spread that information. If you want to copy this presentation, again, reach out to somebody on the team. Until next time, happy house hunting. Daniel Del Rio.